Good morning, people. Today my lecture is on the chapter Management Control in Specialized Organizations. So, as we all understand that control is needed in every organization so that the organization's goals are achieved, and mostly the organization's goal are to earn profit. However, there are certain organizations, certain industries that really do not are into making profit. They may earn profit. However, though there are some certain specialized organizations. So today the lecture is on those organizations. Let's start with it here. Service organizations. Service organizations are businesses that work for a customer and occasionally provide goods, but it is not involved in manufacturing. So service, we understand, providing service, giving service, receiving services. So when a company is into a manufacturing business, they are selling it to the customers. However, they are really not into service, which means that they are looking to earn profit. They would do anything to earn profit. However, things have changed now. So mostly all the organizations have started to realize that customer is very important. You cannot sell anything to a customer. We are intelligent, we understand. So I would not say today that manufacturing industries or companies are not into services. They also do provide services. However, this is about certain specific organizations. So these are organizations that are not involved in manufacturing. Today, services are more important than to only manufacture goods. We know that because you can manufacture goods. However, if the customer is not satisfied, you may not be able to sell that to the customer. The service it has to create services rather than tangible objects in an economy. Thus, the control and service industry is different from management control and manufacturing companies. Manufacturing companies also are doing services these days. However, with this we are focusing only on the service industry. So these industries are creating only services and not tangible objects that such as anything that we purchase, that they are not providing tangible objects, only services that are intangible. You cannot touch services, however you can feel it. What are the features of service organizations? Absence of inventory buffer. As I said, that there is no tangible goods that can be touched or stored. So these organizations have to be very careful because they are providing services. If they are unable to maintain quality, they may suffer a lot, because I would say that if I'm going to a restaurant, if I'm going to a hotel, I would rather see the services of that hotel or restaurant more carefully than seeing the ambience. Services would matter most to me. So it matters to everyone, and such as hotel rooms, airplane seats, these are all services. These are and there is no inventory, there is no you cannot stock, you cannot keep a stock of a hotel room that has gone unsold for that, for this particular day. You cannot keep it now. This day is gone. If this particular room is not sold, uh, I would not say it's a loss, but there is no inventory. It cannot be stored. If it's gone today, it's gone forever. Such it's the same with airplane seats. If the airplane seat for this particular day is not filled, it's gone forever. Difficulty in controlling quality. Manufacturing goods quality can be controlled easily, because if there's any defect, if there's any defect, the manufacturers can come to know of that. However, while providing services, it's rather difficult to measure quality of service that is being provided, because it is intangible. You cannot touch it, so therefore it's a difficulty. However, they are coming up with different mechanisms to control that as well, but this is a feature. It certainly becomes difficult. Labor intensive. Services, who can provide services? We can provide service. Human beings can provide services. A machine cannot provide services. A machine cannot say hello, or a machine would not have that human touch. So these service organizations are very labor intensive. Inseparability of production and consumption. uh, while manufacturing a product, you know that you manufacture it, then you send to a wholesaler, then retailer, then to the consumer. However, when you are providing services, those services are being provided directly to the consumer. There is no separation, there is no separation there. Those are inseparable. So it's important, it's very important, people, for the labor, the person who's providing service, to be very cautious and needs to provide good services. Heterogeneity. People have different, individuals have different uh, different opinion, different nature, different culture. They would have different they would respond differently to different queries. So to bring homogeneity, to bring cohesiveness, uh, organizations should provide training, and they are doing it these days. If you see, whenever you must have worked in organizations. I have worked. Whenever uh, we start in a new organization, or an organization recruits us, they give training. Why do they give training? For us to know what they want from us. Professional service organizations. These are occupations in the tertiary sector of the economy requiring special training in the arts or sciences. Some examples may be architects, auditors, engineers, doctors, etc. So these are niche services, uh, and it requires very high level of skill. As you can see, that professionals are architects, auditors, engineers, doctors. Features of professional service organization. Goals. What is their goal? Uh, the basic asset. These professional service organizations or professionals do not have very good infrastructure, big businesses. No, their main asset is their skill. You would know them by their names. So I may tell you names of many lawyers who are very highly qualified. They are known all over India. I have not seen their offices, or maybe they may have their offices, but what matters is their name, what matters is their skill, and this skill gives them that name. So basically, their asset is their skill, and for that, adequate compensation needs to be given to them. Professionals, they are professionals, and they would not, when you hire a lawyer, they would not, they would give you their services, but they would not understand what their services, what kind of financial implications their services may have upon you. Probably they are quite expensive for you, but they would give their services and they would charge for that. They really do not, architects, such as architects, they design the buildings and they charge their expenses, incomes, whatever it is. They get payments for those. That's it. It is their asset. The architect, the designing is their asset. For doctors, the skill is the asset. Output and input measurement. As such, there is no specific output or input for professionals, for measuring performance of professionals, because uh, uh, when a lawyer gives you their services, they may, or we may also not know what exactly do we require from them. We don't know. They give their services, we make the payment. So it is really very difficult to measure their performance based on, because there is no output there and there is no input as such. What is required of them? Small size. They are usually small in size. They would not, as I said, they would not have very good infrastructure. They have small sizes, and their main asset is their skill. Marketing. Usually these professionals do not market their prod rather their skill is their product, so they really do not market their product very extensively. They do not do that. They do it via lectures, via articles, via blogs. They do not market their product, or rather their skill, going into the market, talking to the customer. They do not do that. It's their name, it's their kind of the speeches, the articles that they write. It's a kind of marketing for them. Okay, so now we come to financial service organizations. By finance, we understand related to money, related to finance. Financial services are the economic services provided by the finance industry, which it encompasses a broad range of businesses that manage money. Some examples are banks, credit card companies, accountancy companies, stock brokerages, etc. So we have banks, we have credit card companies, we have stock trading companies, accountancy companies. These are some organizations that deal into finances, and one of the biggest example is a bank. All the banks that we have deal in financial services. They give financial services to us as consumers. Let's see the features here. Monetary assets. Mostly the assets that these organizations have are monetary, are in the money, in terms of money. time period for transactions. Whatever transactions these financial industries do, to get the output of these transactions that they do, it takes a long time, because uh, they are dealing into money, and money as such uh, is the base, is rather is the base of an economy. So the transactions that these do, we all know about the 2008 recession that happened. So it is said that it happened only because some investment companies, again, some companies dealing in financial services, they took a wrong decision. They might have taken it long ago, but that came into the forefront in 2008, and then the recession came. So some bad some bad transactions, some bad decisions of these industries may have a great impact, although, but that may not happen instantly. For a manufacturing industry, what happens? You produce a product, consumer doesn't like it, you take it, you recall it, and that's gone from the market. There is a loss to the company. However, it does not take a period of 10, 15, 20 years. However, in financial services, it may take this much time. So it's as such, it is difficult to say what exactly is the effect of the transaction that has been done instantly. Risk and reward. uh, the higher the risk, the higher the reward. And so this is what financial services also do. They invest. You must have, rather, there are FDs, fixed deposits, there are recurring deposits, there are then the stocks that people purchase, mutual funds, equity funds. So if you must have noticed, wherever uh, while reading these brochures, you must have noticed that they are informing us that this particular premium that you are paying for this insurance has a very high risk. However, when you take risk. These financial services take, financial organizations take risk, and then the reward is also higher. There is a risk of losing your money. However, if you get it back, the reward is also high. So these are certain the features of how they gain and how they lose. Technology, they have the banks, the financial services, they have come. Previously, what happened? We had to withdraw money from a bank. There was a time from 10 a.m. to 2 p.m. Only within that time you could withdraw, and you after that, when the bank opened next day, then only could you withdraw. However, now we have ATM machines. Now we can withdraw. We can even deposit money through ATMs. So they have improvised their technology. They are coping up with times. That's a very good thing of financial services. Although many financial organizations are very heavily regulated by legislations, by laws, by governments, but they are coping, they are adjusting to time, which is important, because if you do not adjust, you're out of the business, you're out of the eye of the consumer. So, however, it says it's important to understand that the financial sector is heavily controlled by legislations, as the control systems that control in a typical business may not be sufficient for this industry. For a manufacturing organization, for any kind of organization, the management, there is a strong management that handles it. But where finances come, although they have internal controls, a bank may have internal hierarchy, they may have internal controls and checks. A stockbroking company may have internal CEOs, managing directors, managers. However, it still becomes insufficient. So uh, it is controlled by law as well. Insurance industry, we all have insurance, so we all know insurance is the equitable fair transfer of the risk of a loss from one entity to another in exchange for payment. What do? We take an insurance, we pay a premium to the insurance company. Life Insurance Corporation of India, we have team insurances now. Every bank is doing insurance. So what do? We pay them a premium in case of, God forbid, in case of death or untimely death or untimely, rather accident. There are many insurance that we have these days: accident, health, life, car insurance, any kind of insurance we have. So we transfer our risk to them by paying some amount to them, and they insure us. It is a form. However, let me clarify, it's insurance, it's not assurance. So this is to be noted. It is a form of risk management primarily used to hedge against the risk of a contingent uncertain loss. The processes involved in insurance and benefits management system are below: publicity and promotion of products. Until they publicize, how would the consumers know? Product evaluation, enrollment of beneficiaries for the plan. You take an insurance. Uh, for example, I take an insurance. I take a life insurance. So that would be given only after my death. So who would be the beneficiary? It has to be someone from my family, from my immediate family, my spouse, my mother, my father. So the enrollment of those beneficiaries are done. Receipts and accounting of premium. We pay them, they receive it, they account for it. Processing and settlement of claim. So this is what happens for an insurance when we take an insurance, and how do we claim it. So these are the processes: payments, processing and settlement of accounts with vendors, settlement accounts with agents. So with vendors as well as agents, we tend to book it, we tend to take insurances from agents. So what happens when an agent does it with us, rather we do it with agents, they also earn something. Routine and exception reporting for management control. Again, management control has to be there. Reports are prepared to check if everything is in form, everything is correct, everything is going as it should be or not. Customer relations management, accounting and audit, customer relations. If you see, everywhere these terms are being used. Why? Because every industry is looking systems administration. Every industry, they, even these service industries provide us services. However, they also want to earn some profit. So management control, accounting, audit, accountability, responsibility, customer relations, how your relations are with your customer, these are some basic things that every industry needs. Non-profit organizations, we've heard NGOs, non-governmental organizations. Non-profit, those who really are looking to serve the society and not earn huge profits. The manufacturing industry's main goal is to earn profit, but non-profit organizations, yes, they do earn profit. However, their main goal is to serve the society and not earn profit. It's a group organized for purposes other than generating profit and in which no part of the organization's income is distributed to its members, directors, or officers. Some examples are churches, public schools, public clinics and hospitals, museums. Non-profit organizations are usually exempt from tax. So these organizations, obviously they would pay remuneration salaries to their employees because they're employing them. Somebody has to do their work, so they employ people, they pay them for their monthly work, but they do not give a share of profit to their directors, board of directors, trustees. They do not share profit. Profit is kept so for possibly when their work is not going well. For rainy days, they do earn profit, but it is not to be distributed. As happens in manufacturing industries, the CEOs may have a share in profit. Shareholders may share their profit with the CEO, with the management, higher management. But this does not happen in non-profit organizations. What are the features of non-profit organizations? Absence of profit measure. There is no profit that they're looking for. Contributed capital. There are two types of capital that they get. One is plant and one is endowment. Plant is in terms of assets that they get, buildings, equipments, because they are looking to serve the society. So there are people who help them. Okay, so they get plants, they get buildings from the donors. Other is endowment. Endowment means that they get a specific amount. They may get a specific amount, they may get a share, they may get an equity from the contributors. However, they can only use the interest part of it and not the principal amount. For example, I as a gift I give 2 lakh rupees to a non-profit organization, and I tell them you can keep it in you can do whatever, rather you can make a fixed deposit with it, invest it somewhere with the bank, invest in stock, invest in securities, whatever you want to do, but you can only use the interest part of it. The principal amount of 2 lakhs needs to be kept as it is. So what happens, in the principal part is also safe, and they are getting running income from this investment or stock, wherever they invested. Whatever interest they're getting, that becomes their running income. So this is how they get their capital. Fund accounting, they have different types of funds accounting. It's different from a profit organization. They have operating funds, which is for general purposes. They have plant fund and endowment fund for buildings that they are receiving. They have endowment, what have they received in gift, and very other varieties as well. So they have different accounting methods. Governance, they are board of trustees who open this organization. However, they are not well equipped with the management. So they keep employees, they keep management, they keep CEOs, they have all the hierarchies as happens in a profit organization, but they're somewhat different, as they do not share profit with the organization. These are some of the difficulties of management control in service and non-profit organizations. Difficulty in measuring output. There is no set standard against which they are working. so they have difficulty in measuring output. Organizational goals and objectives are less clear. We understand that. Less competitive pressure to improve management control systems. As such, there is no pressure as well because they are non-profit, they are service organizations. They are not working for profit. They do not have to, probably they don't want to compete. They do not have competition. Training systems are not developed, or rather, uh, they their other non-profit organizations are also working like them, and they do not have competition. Training systems are not developed and maintained properly. Motivations and incentives of individuals may differ from those in for-profit organizations. I may join a non-profit organization to work for the society, to give back to the society. So uh, I may do a volunteer work, or I may charge for my services, or I may take a monthly salary. However, uh, I would like to work, if I'm a volunteer, if I'm not taking any money, I would want to work on my own. They may not give me a training. So what actually is the motivation and incentives, why an individual would want to work with them? And it would differ because in a profit organization, people are working for money, but in a non-profit organization they may work for the society. They may want to give back to the society. So it is difficult to uh, actually assess what an individual's requirement, or what an individual thinks of non-profit organizations.